Well, first quarter earnings season is in that final stretch, and so far results have been far better than Wall Street had feared. One example of that, companies stepping up repurchases of their own shares. For more on corporate America's spending spree, we are joined by Scott Chronert, head of U.S. equity strategy at Citi, joining us in studio. Scott, thank you so much for coming in. So I want to start on these buybacks because, as I mentioned, we've got Apple with a record-breaking $110 billion. But then you've got a company like Bumble down over 30% year to date. They have $260 million in cash, $600 million in debt, and they're announcing buybacks. So should investors be viewing all buybacks as created equal here?
Well, I think to a certain degree, yes. The bigger picture here that we want to be attentive to, in our view anyway, is that we're looking for an acceleration in earnings growth this year. With that, we're expecting a significant increase in free cash flow generation. So we're looking for free cash flow for the S&P 500 to grow to the tune of 10% this year. And what that does, it frees up a lot of financial flexibility. Share repurchase is something that's been going on an ongoing basis for several years. Our math is that on a net basis, the S&P aggregate share count's been reduced by about 1% a year over the past several years. We think that trend continues. Okay, so what this does, the free cash flow improvement augments financial flexibility that leads to decisions between CapEx, dividend growth, and repurchase. Many companies are viewing repurchase as a signal that they view their fundamentals as in a pretty attractive position looking forward.
So Scott, just zooming out also and just taking a look at earnings season, what we've heard from corporate America, obviously over the last several weeks, obviously it has been a strong earnings season so far, but I'm curious though, in terms of some of the guidance and the forecast numbers, what is that then? What does the setup look like for the current quarter and then of course the second half of the year?
Color us bullish on the S&P earnings outlook, okay? So going into the quarterly reporting period, it's not uncommon to see expectations come down. So you get to a point where positive surprises are nearly a given, okay? So the positive surprise dynamic with Q1 earnings is not a surprise, okay? First point. Second point, though, is that when you look at what's happened with the aggregate consensus expectations for the full year, they haven't changed.
Right.
Okay, so we call it a beat and hold. But what this does, in turn, given what we know or think we know about the economic condition right now, is that we're going to be in a position for ongoing fundamental tailwinds to support U.S. equities as this year unfolds.
So then what does that leadership look like?
Well, okay, so here's the trick. So last year we know it was all about Mag 7. Okay, it was an important contributor to the aggregate index return. If you look at the performance off of the November lows, okay, it began to reflect broadening, which has been a call of ours going back to last summer actually, and the view had been we wanted a barbell growth in cyclicals. Well, off the November lows, you've had industrials and financials right alongside tech as a leadership. This year, you've seen energy perform quite strongly. My point is that broadening has been happening under the surface. Where does it go from here? This is somewhat controversial, but we are still of the view that we're going to get a Fed pivot as we get in the middle part of this year, perhaps later in the third quarter. What that does is set up for the rotation to continue down a path of those parts of the market that should benefit from lower Fed funds. That's going to include consumer. Okay, so we've gone overweight consumer discretionary. We recently upgraded utilities from a long-standing underweight to a market weight. We've upgraded staples. We've remained positive on banks. We've upgraded autos. My point is that we've begun to shift our focus towards those companies that should benefit from a gradual reduction in short-term interest rates.